What if I told you one three-digit number could decide whether you get approved for a loan, what interest rate you pay, and even whether you qualify for your next apartment? That number is your credit score, and that's what we're going to be talking about today. And understanding how it works could save you thousands of dollars over the course of your lifetime. I am so happy to have you here with me today. Let's get started. There are two main types of credit scores you'll encounter: FICO and VantageScore. FICO scores were developed by the Fair Isaac Corporation and are used in over 90% of lending decisions. This is going to include mortgages, auto loans, and credit cards. Vantage scores, on the other hand, were created by the three credit reporting bureaus: Experian, Equifax, and TransUnion. And this was created as an alternative to the FICO score, and they're commonly used by consumer-facing apps and tools like Credit Karma. The scoring ranges are generally the same for both, where poor credit is 300 to 579, fair is 580 to 669, good is 670 to 739, very good is 740 to 799, and excellent credit is 800 to 850. Now, your score might differ slightly between the two, depending on the data source and scoring model used, but both give a pretty reliable snapshot of your credit health. Your credit score is based on your financial behavior, things like on-time payments, your debt levels, and the length of your credit history. It's a quick way for lenders, landlords, and even employers to evaluate your financial responsibility. Now, a higher score can unlock lower interest rates, faster approvals, and better terms. However, a lower score can mean missed opportunities and higher costs across the board. So let's say you're applying for a $300,000 mortgage over 30 years. Now, with a credit score of 760, you might qualify for a 6.5% interest rate. But if you have a score around 620, that rate could jump to 7.5% or higher. That 1% difference means your monthly payment would increase by over $200, and over the life of your loan, you'd pay more than $72,000 extra in interest. Now, that's the true cost of bad credit. Money lost that could have gone toward investments or savings or other financial goals. There are three major credit bureaus in the U.S.: Equifax, Experian, and TransUnion. Each one maintains its own version of your credit report. The information they have may differ, so it's important to check all three. One bureau could list an account that others don't, or report outdated or incorrect information that needs to be corrected. Now, you're entitled to one free credit report per bureau per year at annualcreditreport.com. So that's three total reports, one each from Equifax, Experian, and TransUnion. Now, your credit score isn't included with those reports, but you can check it by using Credit Karma, as we suggested earlier, Rocket Money, or even your credit card issuers like Discover, Capital One, or Apple Card, which often show your FICO score on your monthly statement or within an app. Make sure to check your own score because it won't hurt your credit, and it's considered a soft inquiry. Now, there are five main factors that influence your credit score. Payment history is number one. It accounts for 35% of your score. Late or missed payments have a major negative impact, so you want to make sure that you're making your payments on time. Credit utilization is the second, and it accounts for 30% of your score. Now, keep your balance below 30% of your total credit limit, and ideally significantly less than that where possible. Number three is the length of your credit history. This represents about 15% of your score, and the longer you've had credit, the better. Keeping older accounts open definitely helps. Number four is new credit. This is about 10% of your score. Opening multiple accounts in a short period can temporarily lower your score. And the last, number five, is credit mix. This also accounts for 10% of your score. Having both revolving accounts like credit cards and installment loans like a car or student loan shows lenders that you can manage different types of credit. Now that you know a little bit more about credit scores and your credit report, I want to give you a few tips to stay on top of your credit. Number one, make sure to set up automatic payments to avoid missed due dates. Number two, make sure to review your reports from all three credit reporting bureaus annually and dispute any inaccuracies directly with the reporting agency where those are found. Number 3, monitor your score regularly. Make use of apps like Credit Karma or Rocket Money, or even your banking apps or your credit card apps to see this information and stay consistent about the management of your credit score. And that's going to do it for today's video. Now, credit scores and credit reports don't need to be scary concepts. The more focus and attention you give these, the more beneficial they can be as tools to lock in tremendous savings over your lifetime. Now, if you enjoyed today's video, why don't you make sure to like this video, subscribe to the channel, and click that notification bell so that you don't miss out on the next one. Also, take a moment to share this with a friend, a family member, or someone else who will find this content and this channel useful. I want to thank you so much for watching, and as always, I encourage you to dream big, to live well, and to do great things. And I look forward to seeing you in the next video.